everyone, I'm Chanel Montaigne and welcome back to Loud Investing. I'm so glad you're here for what might be the most vulnerable episode I've recorded yet. Because until this point, we really covered the foundations, and I feel so proud that I took a balanced and actually quite conservative approach so far, because it allowed me to learn by doing. And it really helped me to get over my initial fears and misguided preconceptions about money. But now I feel ready to take a chance, to really believe in myself in a way that I never had done until this point. Because when people hear taking a risk, quote unquote, they often think about dramatic moments like quitting your job to start a company, or putting your life savings into crypto, or even moving to a new country. But what I want to talk about today is a different kind of risk, the calculated kind. The kind that doesn't make headlines in your life, the ones that actually change everything. So 3 weeks ago, I made a decision that scared me more than any market volatility ever could. And I wanted to share that journey with you, not because I know how it ends, but because I think there's something so powerful in witnessing someone take a leap in real time. So today, we're going behind the scenes of my first real financial risk, how I made the decision, how it felt like, and honestly, how it's going so far. Now, for the longest time, I thought risk was synonymous with recklessness. And growing up, I actually watched certain people around me make some very unconservative and quite risky financial decisions. In some ways, I had become overly conservative as a result. But somewhere along the way, I realized that playing it safe was actually becoming risky for my future. From my experience, I just feel like playing it too safe has sometimes cost me more opportunities than anything else. That being said, the risk I took wasn't throwing money at a hot stock tip, and it wasn't day trading or speculation. It was much more personal than that. I decided to invest significantly more money than I ever had before, not in a single company or a hot tip, but in my diversified portfolio that we've been building together, which now also reflects my long-term goals. We're talking about moving from investing maybe £100 a month to £250 a month. Now, for some of you, that might not sound like much, but for others, it might sound like a fortune. The amount isn't what matters. It's what it represents and how I approach the decision. So this decision meant saying no to some immediate comforts, like no more impulse purchases, no more expensive dinners just because I felt like it, and no more using shopping as entertainment. But here's what made it truly transformational for me. I was investing in my ability to make sound financial decisions, and my confidence and self-trust were just compounding every day. I had to develop what I call a risk assessment framework, a way to understand not just what I could afford to lose financially, but what I could handle emotionally without it destroying my confidence or my motivation to continue investing. Now, let me walk you through this framework because I think it's crucial for everyone considering increasing their investment risk. So first, you'll have to do a financial reality check. Now, we already went through this in episode 1, but being a couple of months in, the positive effect of that process was really sinking in. And I was able to honestly assess with so much more maturity what amount of money I could afford to lose without it impacting my basic needs or my emergency fund. This isn't about planning to lose money. It's about understanding your financial boundaries so you can invest with confidence rather than with fear. For me, this meant looking at my monthly budget, existing obligations and priorities, and determining that £250 per month was doable to put towards some more high-risk investments if I made some lifestyle adjustments. Importantly, losing this amount wouldn't put me in financial distress. It would just mean less discretionary spending in order to balance out with my other goals. Second, we have the emotional comfort test. And we touched on this in previous episodes, specifically episode 3, but this is where it gets really personal. When I set out on this journey a few weeks ago now, I had to ask myself, if my investments dropped 20% next month, would I panic and sell everything, or would I be able to stay calm and stick to my plan? And at the start, I would have probably not been so zen about it all, but this whole process has revealed to me I could handle seeing my portfolio fluctuate by a certain percentage without losing sleep. My only, let's say, red line was anything that threatened my basic financial security and would keep me up at night. That's why it's so important that I go through the process of setting strong financial boundaries and understand exactly what I could truly afford to lose. Third, the time horizon reality. When thinking about investment risk, the main thing to consider is time. Your time horizon is what will ultimately help you mitigate risk. Here's what that means. Let's say the market drops like 30% next year. If you need that money in 2 years for, let's say, a house deposit, you're in a very tricky situation. It means that you might have to sell at a loss. But if you're investing for your retirement that's 20 years away, that same 30% decline will just be noise in the meantime. History shows that markets recover, and over long periods, time essentially smoothens out the bumps. A long investment horizon acts as a powerful buffer, allowing you to ride out turbulence. This means that even if you have a conservative profile, a long-term strategy can allow you to embrace even higher risk assets because time is on your side. Now, Bitcoin is the poster child for this principle because its history is basically a dramatic saga of dizzying ascents and terrifying drops. It's like the very definition of volatility. Let's take a scenario where, for example, there was a drop of 80%. An investor who is focused on, let's say, the daily chaos, they would probably panic and sell everything. But the long-term holder, however, simply would weather the storm. And for them, these crashes are not realized failures, but just temporary chapters in a much longer, and in the case of Bitcoin, ultimately profitable story. Now that we've looked at this framework, let's explore how you can uncover what your actual goals are. And to be honest, this is something that I struggled with initially. And I knew I should invest, but I didn't have clear goals beyond like just having more money. Here's a practical exercise that helped me. Start by writing down what you want your life to look like in 5, 10, and 20 years. Not just financially, but practically. Do you maybe want to work part-time and travel for 3 months a year? Maybe it's starting your own business or buying a home. Perhaps you want to start a family or be able to provide for your aging parents. Each of these life visions have different financial requirements and also timelines. Once you can visualize the life that you want, you can work backwards to figure out what financial foundations you need to support it. For example, wanting to work part-time in 10 years might mean you need to build enough passive income to replace half your salary. That's a very different goal than wanting to buy a house in 3 years, which requires a specific lump sum for a deposit. So let's start with short term and say this is between 1 and 3 years. This is for goals like saving for a wedding or a car. And here you actually want lower risk because you need the money relatively soon and you can't wait for markets to recover if they dip. Now, historically, the S&P 500 has had negative returns in about 25% of all one-year periods. But this drops to around 16 to 18% of all 3-year periods. And this means that investing in the S&P 500 is perhaps something to consider more for a 3-year time frame, but maybe less so if it's under that timeline. Now moving on to medium term, and let's say this is between 3 to 10 years. Now, this might be saving for a house deposit or starting a business. You can take moderate risk here because you have some time to recover from market volatility. Now, the data shows that over 5-year periods, the S&P 500 has been positive about 88% of the time. However, even in positive periods, you might see significant volatility. The average drawdown is about 14%, which is an inter-year price movement from the highs to the lows, meaning even in years that end positively, you'll likely see your portfolio drop substantially at some point. Now, in the case of the S&P 500 then, you could argue that this is an investment choice that is aligned with your goal. And now, last but not least, long term. So this would correspond to like 10 plus years, let's say. And this could be retirement savings or for children's education fees. And here you can typically handle higher risk because time is your biggest advantage for riding out market cycles. Historically, and I love this fact, but no one has ever lost money investing in the S&P 500 if they have held it for more than 20 years. This is why long-term investors can afford to ride out bear markets, because history suggests that patience is typically rewarded, though past performance doesn't guarantee that the same will happen again in the future. Now, this means that the S&P 500 will be a great choice when looking at more long-term goals. Now that we've covered all these foundational points, let's see what this process was like for me in reality. I'll walk you through how I actually made this decision about how I took my first real financial risk by taking my portfolio to the next level, because I think the process matters as much as the outcome. Now, first, I had to get honest about my real numbers. Not numbers I wish I had, and not numbers I told myself I had, but actual realities of my financial situation. And I looked at my income, I looked at my expenses, and my current savings rate, and I calculated what my financial future would look like if I continued on the same path. That's when I realized I had two choices. I could either gradually increase my investments over the next 5 years, or I could make a bigger jump now and adjust my lifestyle to match. So I chose the jump. But I didn't make this decision in a vacuum. I spent 2 weeks testing it out mentally first, and I looked at my spending from the previous 3 months and identified exactly where the extra money would come from. I meal planned to reduce food costs, and I canceled all subscriptions I wasn't really using anymore. And I found free alternatives for entertainment I was paying for. Now, the breakthrough moment came when I realized that most of my spending was habitual, not intentional. And I was spending money on things that didn't even improve my life just because I always had them. Here's what really surprised me. When I started thinking about this decision as investing in my future self instead of taking money away from myself, like my current self, everything shifted. And instead of feeling deprived, I started feeling empowered. I called my best friend and told her what I was thinking. And she asked me one question that just sealed the deal. She asked me, what would future you think about present you making this choice? And I just knew immediately that future me would be so grateful that present me was brave enough to prioritize her. But I need to be honest with you about what this actually felt like, because I think we don't talk enough about the emotional side of financial decisions. The first week after I set up the increased automated transfer, I felt a mix of excitement, but also of panic. And every time I looked at my account balance, which was lower than usual, my stomach would tighten a little. And I found myself second-guessing small purchases in a way I never had before. Like, should I buy that coffee? Is this bill too high? The mental energy I was spending on these micro decisions was exhausting. But by the second week, I started feeling lighter. Not because I had more money, I actually had less available cash than usual, but because I had made a decision that aligned with my values. Remember in episode 3 when we talked about matching your approach to your psychology? Well, this experience taught me something about my own psychology that I hadn't fully understood before. And I realized that I'm someone who feels more secure when I'm actively building towards something than when I'm just maintaining the status quo. The anxiety I felt about having less spending money was actually smaller than the anxiety I had been carrying around about not investing enough for my future. And there's this amazing quote by Anais Nin, which is, "And the day came when the risk to remain tight in a bud was more painful than the risk it took to blossom." And that's exactly what this felt like. The risk of staying where I was, underinvesting, under-saving, and playing small had become more frightening than the risk of committing more to myself. It's been 3 weeks, and I want to give you the real update. Not some highlight reel, but actual experience. Now, financially, it's too early to see significant investment returns, obviously, but what I can tell you is that the markets have been pretty volatile during these weeks. And there was one day when I checked my portfolio and it was down like 3%. Now, the old me might have been panicked, but something has shifted in how I think about these fluctuations, because I made this decision so intentionally, because I went through such a deliberate process to get there. I felt like just calm and not indifferent. I definitely noticed this dip, but calm, because I had prepared myself mentally for volatility. And more importantly, I trusted my decision-making process. Now, the lifestyle changes have been more noticeable. I've become much more intentional about spending. And instead of mindlessly buying things, I actually find myself asking, is this more important than my actual future financial freedom? Most of the time, the answer is no. And that feels good rather than restrictive. I've also discovered that some of the things I thought I needed for happiness were actually just habits. I used to buy expensive coffee every single morning, and now I make coffee at home, and I genuinely enjoy the ritual of it so much. I also used to order a takeaway when I was tired, and now instead I have a list of simple meals that I can make in under 15 minutes, and I feel so much better about what I'm eating as a bonus. But here's the most unexpected result. My relationship with money has fundamentally changed. I used to avoid looking at my investment accounts because, seeing the numbers made me anxious. I now check my accounts regularly, not in the obsessive way that I used to previously when I was anxious about the fluctuations. Now I just check them with genuine interest and a healthy sense of pride. What I've learned from this experience goes way beyond investing. It's about the relationship between risk and identity. For years, I identified as someone who, quote unquote, wasn't good with money and who couldn't afford to invest much. And those identities were comfortable because they required nothing of me. And they were also limiting me in ways I didn't fully recognize. Taking this risk by committing more to myself forced me to try on a new identity. As someone who prioritizes her financial future, who makes intentional choices, and someone who believes she's worth investing in. And here's what's wild. The moment I started acting like that person, I started becoming that person. And this connects me back to something we discussed in our investor profiles episode. Now, remember how I mentioned that the best investment strategy is the one that aligns with your psychology? Well, I'm discovering that sometimes you have to take a risk to find out what your psychology actually is. I thought I was risk averse, but turns out I was just risk conscious. And when I approached this decision with intention and preparation, what felt like a big risk started feeling like a logical step. Risk isn't always loud and dramatic. Sometimes it's a quiet decision to stop shrinking, to stop playing smaller than your actual potential, and to stop accepting less than your worth. So here's my question for you this week. I really want you to think about this. What's one risk that you've been avoiding out of fear of failing? I'm not talking about reckless risks. I'm talking about the calculated risks that your future self would thank you for taking. Maybe it's investing more. Maybe it's asking for a raise. Maybe it's starting that side project that you keep thinking about. Here's what I want you to do. Identify that risk and then spend 1 week researching about it. Not to talk yourself out of it, but to understand it better. What would it actually require? What are the real consequences if it doesn't work out? And what support would you need? Use the risk assessment framework we discussed today and identify what's your financial comfort zone, what's your emotional comfort zone, and what's your time horizon. And if you're ready to take that risk, I want to hear about it. So drop a comment on our YouTube channel or tag us on Instagram. I love seeing what risks our Loud Investing community is taking, and who knows, your story might inspire someone else to take their leap. If you found this episode helpful, please subscribe and share it with someone who might need to hear about taking thoughtful risks. And if you want to dive deeper into more technical investment strategies, check out eToro's Academy. There's some incredible content on there, including more on portfolio construction. Until next time, I'm Chanel Montaigne, and I'm still figuring this all out right alongside you. See you next week on Loud Investing.